recording. And now let's just wait a moment so the attendees can enter.
Okay, perfect. Hey, thank you very much. Good morning to everyone. We're very pleased to have this audience here. Very interesting times to have this meeting. So we have the honor to have Claudio Soto. This is the first time that we're hosting him as a board member of the Central Bank of Chile. We've had him in the past when in his previous role when he was at Santander. But as I mentioned, this is the first time that we're hosting him as a Central Bank board member. So Claudio, everyone knows Claudio very well. He was a market participant for a very long time. So Claudio, thank you very much for accepting this invitation. I know it's we're probably going to have a lot of questions, and you probably also have a lot of questions of what we're seeing in the past few days. So it's going to be interesting. So Claudio agreed to start with some initial remarks and a presentation. Based mostly on the latest EPOM, and then we'll open it up for Q&A. Please, if you have any questions, feel free to use the chat. Send it to me. I'll try to filter questions, and I'll try to pass over the questions as many as possible. Or to those of you who have Bloomberg, you can also contact me there and send me questions there, and we'll try to make as many questions as possible. Thank you very much. And Claudio, please, the floor is all yours.
Well, thank you, Andres, for the invitation. Let me share with you the presentation. Yes, as Andres said, this is based on our latest EPOM. Do you have it on the screen already?
Yes, perfect. Okay,
great. So my idea is to go over what was the EPOM that we published a couple of weeks ago, and then I will try to comment briefly on the market developments in the last few days, and then I can give you some assessment that we have done up to now. This is very, very preliminary, of course, and then we can discuss in the Q&A more in depth some particular issues. So in terms of the EPOM, what we saw a couple of weeks ago was that basically the world activity was somehow in line with what we expected already back in December. Our trade partners grew a little bit more than what we were expecting in December, basically because of the rebound in China by the end of last year. The US slowed down a bit in the last quarter of last year, but was somehow in line with what we were expecting. The big surprise was the speed up of China at the end of last year, and the figures we got for the beginning of this year also show that the activity was somehow in line with what we were expecting. Now, the big issue was already at the beginning of March when we were writing the inflation report, increasing the uncertainty. This is with data up to the first week of March, and you see there that uncertainty index already showed that there was an increase in uncertainty, and the outlook for growth in the world was beginning to change, not too much at that time, but the forecast for the US, for example, you can see there, were revised a bit downwards from previous month. The revision were most heavy on Europe, where the data was soft in the first part of the year, but there were no big revision at the time for the outlook of the main trading partners. If you look at the the PMIs at the beginning of the year were not too bad, so activity was relatively in good shape at the time. But we saw already that uncertainty was increasing, and that had an impact in our estimation for growth. And the big issue in the US for us at the time was inflation. Inflation remained relatively stubborn, in particular because of service inflation was very sticky. And already back then, again, a couple of weeks ago, we saw an increase in inflation expectation by consumers, basically because at that moment already were the announcement of tariff for Canada and Mexico were on the table, and there was some fear that you would have more tariff down the road, and that was already reflected in inflation expectation. And because of that, we changed our outlook for what the Fed would do this year. We assumed two cuts for the policy rate by the Fed this year, and then some more next year. The market had a big change, of course, in their view of what the Fed would do this year. But also, in our case, we changed a bit our view. In December, we were expecting three cuts this year. Now we were expecting 2 cuts, more or less aligned with what the market was expecting at that moment. One of the big things that we discussed in the inflation report was this rotation in asset preferences away from U.S. risky asset into asset from emerging markets, China, Latam, but also Europe, because of the change in fiscal policy that was, giving a boost to economic activity in the Eurozone. That was also reflected in long-term rates, where we saw this increase in German bonds vis-a-vis the fall in U.S. treasuries 10 years. So there was this particular issue that we discussed in the inflation report about asset rotation. Now, in terms of local activity, what we saw is that Chilean GDP grew more than expected in the last part of last year. There were some particular issues here related to the external sector. There are very specific things related, for example, to tourism, and also particular kind of exports that had a big increase in the last part of last year and also at the beginning of this year. Those we were expecting to be transitory factors that push up GDP. But overall, we saw an increase in GDP larger than expected. The year ended up with a 2.6 increase. We were expecting 2.3. And also there was a revision upward in the level of activity for 2024, 2023 also. And you can see there on the right-hand side how services had a big increase. Already it came from before, but the last part of last year we saw an increase in services. This is linked in part to the depreciation of our currency in the last part of last year. So Chile became more competitive in the last part of last year. But also there was this impulse of some specific factors like tourism coming from Argentina mainly, and also from Brazil. Now, if you look at demand, domestic demand, consumption, private consumption remained relatively flat, but there were some signs of recovery, particularly in the case of durable goods. You can see there on the left-hand side, the green line, the durable consumption was recovering already at the end of last year, and also services. So we expect that trend to continue down the road. We have seen a recovery in the labor market, so an increase in labor in job creation. Also, wages have been increasing substantially. So the labor income gives support to sustain increase in consumption. This is part of our assessment for this year. So a recovery of consumption, not too fast. It's a relatively mild recovery, but we think that the fundamentals are there. And also we see already in the data that consumption has been going up. And also in the case of investment, we saw a recovery in both components, equipment and construction. And here, again, as we discussed in previous IPOM, we see a big push coming from the mining activities. Mining activities have been pushing investment upward. Whereas housing investment remained relatively flat. We don't see much activity in the case of housing. So most of the push for investment comes from mining activities that we expect to continue down the road. So we expect this recovery in investment to continue this year, throughout this year and next year. we have the data from the survey done to big companies, and that show that there are important projects in the pipeline. So that ensures that there will be a good investment in the years to come. Now, talking to inflation, well, inflation after reaching almost the target at the end, the mid 2024, there was a rebound of of inflation, mainly due to the volatile component of investment. You see there the blue line, the volatile investment went up. Also, the core component went up, but not too much, but also it went up. But it was mostly the volatile component that pushed inflation upward in the last part of last year and also the beginning of this year. Now, what we've seen in inflation was somehow expected. We already saw that coming in our inflation reporting back in June, mainly because at that moment we discussed about the electricity shock. You can see there the electricity CPI that increased substantially. This is just a recognition of past price hikes that didn't occur because of regulation factors. So now prices aligned to what they would have had to be. So there was this normalization of electricity prices. It occurs in a very short period of time. That's why we had this push in inflation. But there were other components in cost that also pushed up inflation, mainly the exchange rate. We saw a real depreciation of the currency in the last part of last year. You can see that on the left-hand side. And in the middle, you see the labor cost index that also raised substantially. There are some regulation issues here again, pushing up a labor cost, increasing the minimum wage. This is one of the factors. The reduction in the number of legal hours to work that also occurred last year. Those were two regulations that pushed up somehow labor costs. And now we are seeing also a recovery in the labor market that also is pushing up somehow wages. So those are three, let's say, supply shocks on inflation that had an impact in the last part of last year, which will impact year-on-year CPI readings, at least during the first part of this year. The second part of this year, base effect will play out, and therefore we should see a substantial reduction in inflation, which is part of our projection that we'll show you in a minute. Now, we discuss about risk for inflation in the inflation report, and we see two sorts of risk. One is that margins are relatively tight, so further shocks in a context of relatively tight margins could spread out to inflation, so the pass-through could be higher in the context that we're seeing now. And the other risk factor are inflation expectations that have moved up. We have two measures of inflation expectation that have deviated from the 3% target. So here are the challenges that we face in terms of managing inflation and bringing inflation back to the 3% target within our horizon. Now, let me talk a bit about our forecast in terms of global output and our trade partners' output. We revised it downwards a bit, mainly because of the US. At that moment, we already included in our projection a reduction in GDP for the US. More than because of the trade channel here, we assume that the uncertainty that was already present in markets at that moment would have an impact, not only in the US, but also in other countries. That's why we revised downward the forecast for 2025 and 2026 for most of our trade partners. In terms of the copper price, we assume that the copper price will remain at 4.3% more or less, which was the forecast that we did already back in December. So all the increase in the copper price that we saw in recent weeks in the case of the US market was not part of the baseline scenario that we assume in our inflation report. We consider that fundamentals can explain a price that is at 4.3% more or less, but we don't see fundamentals explaining a copper price that is much higher than that, neither a price that is much lower than that. Okay, so we didn't change much our assessment in terms of the copper price. In terms of activity, we revised GDP upward this year from a range between 1.5, 2.5, up to 2.75 to 2.75. So it's a mild revision upward because of the beginning of the year we saw more activity, and we think that there is some more persistency in part of the increasing activity that we saw at the beginning of the year. But for next year and 2027, we remain the same. We keep the same range between 1.5, 2.5, which is aligned to our assessment of trend GDP. So trend GDP, we estimate it to be around 2%. So we don't change much our view on medium-term growth. Here you can see the level of consumption investment. In general, they don't change much with respect to what we saw in December, except the case of the gross capital formation investment, because there was a revision upward, not only at the margin, but also backward. So we saw a revision back to 2023 up, and that is coherent to what we see here in our new forecast. So in terms of growth, doesn't change much, but the level of investment has been revised upward in the latest revision from national accounts. So in terms of inflation, as in December, we see a rapid decline of inflation by the end of this year. Base effect will help bringing down CPI inflation back to target. We will remain with a CPI running at 4.5%, 5% during the first part of this year. That is not a surprise. We expected that to be the case already in December because, you know, this one and for all shocks that we saw, particularly in the case of electricity, that will keep the price level above from now onwards. So when you compare year on year, you have this substantial increase, but then the base effect will play around, and you will see a rapid decline in inflation. So we keep our forecast that inflation should be at around 3% already by the first quarter of next year. So finally, in terms of the monetary policy outlook, this is the corridor. The corridor changed a little bit with respect to what we saw in December. Basically, here we see, first of all, somehow more activity, and also there is some risk management consideration that are embedded here in the outlook for the corridor. We saw two scenarios that mark the limit of the corridor. One is where you have, you know, more shocks to inflation. As I told you, there are risks for inflation, and if we see more shocks to inflation, then we would have to deviate on the upside for monetary policy as compared to the center of the corridor. And then there is another sensitivity scenario where we see a downward pressure on inflation coming from activity, probably linked to global activity, and that is the case where we have this downward path for the monetary policy rate that marks the lower part of the corridor. You can see there that the middle part of the corridor at that moment, starting next year, was below what the market was expecting. We keep our estimation for the neutral rate to be between 3.5, 4.5. Therefore, eventually, if everything moves inflation clearly back to target, then eventually we should bring our policy rate towards the range of to be considered to be neutral. That implies lowering the policy rate from the current level of 5%. okay? So that is what we saw a couple of weeks ago. Of course, we have much more volatility in markets today. We have a box in the inflation report where we discuss the implication of the trade war and all the geopolitical issues that we were seeing at that moment. And we claim that in the short run, at least, the main impact on our economy of the global uncertainty will come through financial shocks or financial issues. We have seen a lot of volatility in markets today, but the stock market in Chile has remained relatively solid. We can discuss about that. We have seen a lot of volatility in the case of the copper price, but also a significant fall in the oil price. We are a net importer of oil, therefore the fall in the oil price will benefit us. But the effect on the copper price, we have to see to what extent is a more persistent effect on the copper or not. In any case, the value of the copper price right now is not too much far away from what we were expecting to be the price during this year, so it doesn't change much our baseline scenario in that case. But in the case of the oil price, definitely the spot price is below what we were expecting. So as I said, the volatility in financial market is, at least in the short run, is what we could see to have more impact on our economy right now. So we have to see how it evolves. I don't know, Andres, if you want, we can open up to Q&As now.
Thank you, Claudio, for that comprehensive presentation. Yeah, let me start with, actually, you mentioned that box that you published on the latest EPOM, which has some of the main considerations of potential negative, positive effects that can be of an impact for Chile. But on that same box, you did mention that you consider all other sensitivity scenarios under more adverse conditions. And you could probably argue that the announcements that we had last week from the US were probably more aggressive than most market participants were expecting. There were some surprises, maybe, especially with some countries being subject to tariffs. Like, for example, some of our Latin American countries, maybe we were not expecting to have these reciprocal tariffs, especially if you compare it to what we actually charge to the US, which is lower than that. So I want to have a little bit of your first impressions of these announcements compared to probably your baseline scenario that you had in your EPOM, and how we should think about, or how you are thinking about how the process could evolve from now on, considering this information that we have today, which is a big if, of course, because there's a lot of things that can change in the next few hours, even hours. So, but just to have a first impression from you, and then we can probably dig in a little bit on some details, and of course, from the audience, if you want to ask some specific questions, please let Claudio know.
Yeah. So, well, it's very difficult to me to assess what could happen from now onwards. Just let me give you some hints on what I see are the impact of the trade war on the Chilean economy. So there are several channels that could affect Chile. There are some channels that, of course, would have a negative impact on our economy, but there are some channels that could have a positive impact on our economy. Okay, so we have to weight those channels to see what would it be the net impact. So on the negative side, of course, is global growth. The uncertainty would have an impact on global growth, and that, of course, would have an impact on our economy. That is definitely could have a negative impact on growth. Now, in terms of trade deviation, because not all countries have received the same tariffs, right? Chile doesn't have a large import substitution industry. We don't have a large import substitution industry. So what could happen here is that we get cheaper goods from other countries due to trade deviation. All goods that cannot be sold into the US will have to be sold all around. So we could benefit from cheaper goods coming from other countries that have been subject to tariff. That in net, that could have a net positive impact on our economy. Okay, and of course, all our industries that have been subject to tariff in the US could have a negative impact. Although in general we have sectors, external sectors that have a relatively inelastic demand. So the impact on activity might be not too large. So we have to see. There are some differences there. The salmon industry on the one hand, for example, or the lumber, although lumber was excluded in the first round. So we have to see. But all in all, I think the negative impact on our activity could come mostly from a global slowdown rather than the specific impact of a tariff on our economy. And there are some compensating factors, as I said, due to trade deviation that could benefit us. Now, in the short term, as I said, I think the volatility in markets could play around. The increase in uncertainty would also have an impact on Chilean activity. As I said, the stock exchange here has not suffered a big adjustment up to now. So these are good news for us. We have seen a depreciation of the currency, not too large, I would say, because of the, I mean, you can explain to large extent the depreciation of the currency with the fall in the copper price. I think that is, of course, having an impact, and uncertainty also has an impact. So we have to see how this volatility in markets plays around, how it evolves. It's just too early to have an assessment. And so we have to let's see how it evolves before having a conclusion on the net impact on activity in Chile and the outlook for inflation.
Right, of course. So let me ask you something regarding the framework in which we should think about, or in which you are thinking about monetary policy in Chile. And the reason why I'm asking you this is because last week, after the trade tariff, the tariff announcement was made, Jerome Powell made a speech in the US in some event that they had planned after that. And there was a question in which basically they asked him, so how does the Fed react to this type of situations where there's a big tension between a situation like the one that we're facing right now, in which potentially there's going to be a significant increase in prices, but at the same time there's an potential important impact on growth and the labor market. And basically the answer from Powell was, well, we have to think about how far each variable is from its goal, and more or less think about how long it will take for each to get back to that goal. And that will define a little bit the focus on which of the two main objectives will have a little bit more weight on our decision process. But of course, that's in the US, where they have a dual mandate. In Chile, you have a primary target, which is inflation. And at this stage, at least from the information that we have today, growth seems to be more or less in line with long-term levels, but inflation is clearly much higher. So thinking about how this decision from the US might have an impact on Chile, how are you thinking about these things that could potentially push prices and create some price pressures in the short term for Chile? How does this compensates with the issue about growth and the labor market. And especially now, we're an this is an emerging economy. So of course, the exchange rate starts to have an important impact on the decisions. As you mentioned, I mean, there's been a relatively contained depreciation, although it's been quite significant in the past couple of days. Today it's trading at 990 already. So can you give us a little bit of that framework on how would you think about this going forward and compared to the expectations that you had on the outlook for monetary policy?
Well, the framework is pretty clear. We focus on inflation on a 2-year horizon. In the medium term, the main driver of inflation is the output gap. The output gap is driven by activity. In the short run, the exchange rate plays a role in terms of inflation. In the current conjuncture, there could be an adjustment in the exchange rate. We have to see. We don't know yet, but in the new global trade configuration, there will be adjustment in the currencies, globally speaking, and part of the adjustment would have to be done by our currency. We don't know yet the direction and the size of the adjustment, but eventually there will be an adjustment in the currency to respond to the global eventual new changes in the global trade pattern. But there is an adjustment in relative prices, okay, and has to occur in an orderly fashion. We would care about having an orderly adjustment in the relative prices here in terms of the exchange rate eventually. But in the medium term, inflation will be driven by the output gap, and so we have to take into account how the current events will affect our activity and the output gap, and that will give us a hint on the evolution of inflation in the medium term. And monetary policy will have to take that into consideration to ensure that we reach our target on a 2-year horizon. Now, there are risks. I mentioned that already in March, before all the turmoil that we're seeing now, we recognize that there are risks for inflation coming from the tight margins that we see, and the fact that given that the inflation has been running above target for a while already, inflation expectations have moved up, and that is also, of course, a source of concern for us. And we have to see how the baseline scenario changes with the current events, but also how risk factors for inflation are affected. So we have to take both things in consideration, and that would define the assessment that we do for our monetary strategy. Yeah,
I mean, so let me just give you a little bit of a feedback of some of the conversations that we have with some clients in the past couple of days after last week's announcement. So basically, people are telling me, okay, so under these circumstances that the world is facing, it seems to a lot of people that when assessing how much this could potentially impact growth in Chile because of the external scenario, because of some specific considerations, I mean, not just because of the global scenario, but also some specific considerations that apply to Chile. For example, the fact that Chile's main trading partner is China, and China could potentially be significantly affected by this whole situation because it's subject to much higher tariffs. It poses additional complications for the growth scenario, for the growth outlook for Chile. Chile being having a strategic role in global supply chains, that also creates additional complications for particular for Chile. There are some positives which you mentioned right now, and on the other hand, there's the issue of inflation. So of course, if inflation is going to be higher in the US, that could potentially translate into potentially more inflation in Chile, but it seems a little bit less contained. But of course, the exchange rate is an issue because of how much pass-through can be there. But then there's the issue that inflation in Chile right now is close to 5%, as opposed to the target, which is 3%. So in the end, I would think that the main conclusion that people tell me about this whole situation is that under these circumstances, the most likely scenario is that in the end, monetary policy will have to react to being easier in the next year or whatever, because in the end, growth is going to have a much more important weight than inflation, and in a sense, growth is going to drag inflation lower. So I'd like to hear a little bit your thoughts on this, or because you did mention some considerations about inflation being very high and some risk factors that you posed on the POM, but I'd like to understand a little bit more that how concerned are you from those, or maybe if there's a misinterpretation of how much global inflation can translate into the Chilean economy under these circumstances.
Okay. Yeah, just one important clarification point. It's not that we have more weight on activity vis-a-vis inflation or the other way around. Our focus is inflation. No, I understand.
No, right, yeah.
So the thing is that if we see that the output gap widens because of low activity, that would create downward pressures on inflation. That would imply that we don't reach our target, our 3% target. So under that circumstances, we should act with our monetary policy. We need inflation to be at 3%, not above, not below 3%. Now, in the short term, we will have eventually counterbalancing forces. On the one hand, the currency could create some more inflationary pressures in the short run. It is not clear to me how global inflation will evolve under these circumstances, because it's true that inflation in the US could go higher because of tariffs. But if global activity deteriorates, that could create downward pressures on inflation. We already see the oil price going down significantly. That also could create downward pressure on global inflation. And as I said at the beginning, trade deviation could also bring downward pressure on inflation to Chile. I mean, imports coming from Asia could be cheaper. We don't know, but eventually could be cheaper. So it's not clear the net effect on inflation, on global inflation. And so we will have all these forces playing around in the short run. And then in the medium term, of course, activity would be an important driver of inflation, and we have to look at it carefully. But again, I think it's too early to have an assessment. Things might, evolve in a different way in the coming days. Also, as I tell you, our stock market is signaling that at least the view of the impact of the global turmoil on Chile seems to be more muted. The reason for that, our trade structure probably will not be so much affected by tariff directly, and most of the impact will come from global growth. Okay, so we have to be looking at the changes in the global outlook for growth to assess what it would be the impact for growth in Chile.
Okay. Now, looking at the current situation of growth, and the starting point from what is to come, because of course, again, there's a lot of uncertainty. We don't know how this is going to evolve, but from a starting point. So in the past couple of months, it seems that growth has been outperforming, or it's been maybe a little bit better than you were expecting. Since the last IPOM, we had the latest TIMASEC. The headline number doesn't look good, of course, because of some seasonal considerations and because of the blackout in February. We all know that. But when looking at the details, it seems that, for example, the behavior of services, and particularly commerce, seem to be very healthy. We had in January a growth rate of 9%. In the February MASEC, it was low, but if you make the adjustments because of the blackout and because of the leap year, you could potentially argue that it was above 7.5%, which is very healthy. So my question there is, you did mention the issue about demand coming from tourism, particularly Argentinians and Brazilians. I think some of your economists published a blog recently in the central bank website talking about that issue. So I'd like to hear your impressions on how much that is affecting the positive numbers that we're seeing in the first couple of months of this year, to have a little bit of an impression of, okay, what does this mean for actual domestic demand for Chileans? Because, you know, it might mean, okay, it's Brazilians and Argentinians which are pushing up demand, but maybe the Chilean state of consumption is not that strong. But at the same time, you have potential price pressures that could arise from this demand coming from abroad. So how are you interpreting that, and how do you think this could evolve? Is this something that we should expect to just wane as the year progresses, or how are you seeing those things?
Yeah, no, definitely we had those seasonal factors. Tourism is very seasonal here, so that is a seasonal factor. There were some combination of factors that explain why we had such a good season. The relatively weak currency, in particular vis-a-vis the Argentinian peso. So the bilateral exchange rate was very competitive for us this year. So that explained part of what we saw. So there are some particular kind of exports that had a very good season also, cherries in particular. And that explained to a large extent the very high figures that we saw at the end of this year and January also. But also there are some other exports that are not so seasonal, that had more momentum probably. And that explained some of the revision upward of our outlook. But also what we see in the margin is a recovery in the labor market. So up to now, the surprises were, you know, probably one-time effects on the export sector, services exports and goods exports. But down the road, we also see some more fundamental forces pushing up demand a bit, not too much yet, on consumption on the one hand, because of the labor market. And in the case of investment, in general, we see a pipeline of big projects that will advance and that will give some support of investment down the road. Most of them coming from mining activities, but also energy. The energy sector has some important projects in the pipeline. So yeah, one is what happened in the past. So this probably once and for all effects on tourism and stuff like that. But also down the road, there are some forces that are helping the economy to recover in a more sustained way. Up to now, just a mild revision upward for growth this year, and not too much. We have to see the figures coming down the road where that is more sustained. And also we have to play it around with what we see in the global economy. So are the both forces that are going to be, you know, moving our forecast in the next revisions.
In terms of what you mentioned about some of the fundamentals that you're seeing for consumption and investment, I'd like to touch a little bit on both. So let me just separate questions. So let me ask first about consumption, and then I'll turn over to investment. With regards to consumption, you mentioned some fundamentals, particularly from indicators from the labor market. And basically some of the things that you've mentioned is that labor costs and wage growth has been significant. And in a sense, probably, I don't know how much it has surprised you that this increases in labor costs and wage growth have probably lasted maybe longer than you probably expected. I'm not sure if that is the case, because, you know, it's been happening for already for a while. You know, at some point, I guess you were expecting this to start to fade a little bit, but so far those figures still to seem very, very, very strong, very healthy. Of course, we had the minimum wage hike as well in January. There's one in just around the corner in a couple of months. But when you look at the labor market, at the quantities, yeah, there has been some sort of an improvement in the unemployment rate. But the latest figure actually surprised to the upside. It went up again. And one thing that I want to point out is that the amount of jobs created in the past year have been mostly concentrated as people who qualified as being underemployed. So of course it's not the same as being fully employed, with high qualities, etc., and high levels of pay, as opposed to someone who is underemployed. So I'd like to hear a bit your thoughts on how you are assessing the issue about the labor market when it comes to the unemployment rate, and how this could be seen as a gauge of the strength of consumers, considering this situation in which underemployment is the one that is mostly lifting the weight of job creation.
Yeah. Well, what we saw in the last years is that there was a more dynamic job creation, but also when you look at administrative data, so people that are, in the putting money in the social security, that data show a rebound in the last figure. So it's true that when you look at the whole year, probably the self-employment, which probably is lower quality employment, explain an important component of job creation. But in the last figures are more what explain the rebound is formal employment, so better quality employment. And that's why we see that down the road there are some support for consumption. Okay, it's not what happened last year, but it is what is happening at the margin. And also, the wages have been going up, probably in part reflecting the increase in the minimum wage that is pushing up the whole wage structure. But also not only the lower part of the distribution of wages have been moving up, but also the middle part of the wage structure. So in terms of the labor income, we see it going up in the next quarters, and that's why we see some support for consumption. Now, in terms of the unemployment rate, last year we revised our estimation for the NAIRU, for the non-accelerating unemployment rate, and we estimated to be in a range between 7.5 up to 8.5. So having an unemployment of 8.5 is in the upper bound of that range. Doesn't really imply that we will get too much slackness coming from the labor market at that level. And why we have revised upward our estimation of the NAIRU? Well, basically because productivity in the economy has been sluggish for several years by now, and you can explain the increase in the unemployment, the NAIRU, or more structural unemployment rate, because of this slackness in productivity. Okay.
Okay. And then turn it over to investment. So yeah, so you've mentioned that some of the surveys are showing an increase on investment projects in the pipeline. But how are you interpreting the current state of bank loans in commercial activity? I mean, you've been mentioning this in the past couple of EPOMs of the weakness, and we've been talking about the weakness that we've seen in commercial loans. But again, it seems to be lasting much more than expected. Actually, the latest figure that came from for February, if I'm not mistaken, actually shows a significant decline in real terms of close to 5% actually. So you don't seem to see a stabilization, and this is stock levels. Now we're not necessarily talking about flows, because I know that flows have been performing a little bit better, but I don't know how much it has surprised you for the beginning of the year to see that commercial loans keep on being very sluggish, actually contracting, even though you mentioned that interest rates, market interest rates have been, or the policy rate has been transmitted to market rates. So I'd like to hear your thoughts on how much that has surprised you. How do you interpret the continuous sluggishness and weakness of commercial loans, and if we're expecting to see a recovery anytime soon? Of course, with the uncertainty that is coming up, things might change, but so far I'd like to hear your thoughts on this issue in terms of what it means for the investment outlook.
Yeah. Well, so first of all, you have to remember that companies access to a lot of liquidity during the pandemic, in the period of low rates and all the warranties program by the government. Companies really access to a lot of liquidity, so they had a lot of cash, and so part of the adjustment to that, the excess liquidity or excess cash, would have had to be as it happened, with a decline in commercial loans. So probably it went beyond what we were expecting, or I was expecting, and part of that reflects the fact that whereas investment is picking up, it's not across the board. We have seen some sectors where investment is clearly improving, but there are some sluggish sectors, in particular housing, which relies much more on bank loans than the mining activities. Mining activities and energy activities rely more on the capital markets and less on banking loans, whereas the housing investment relies much more on banking, and that's why probably the commercial credit is still sluggish, reflecting this unbalanced recovery of investment. Now, in the margin, we see a recovery in flows. We have analyzed that internally, and flow seems to be recovering, and eventually that increase in flows we translate into stocks. So we have to wait a bit, but eventually we'll see a rebound in stock also. Yeah, the surprise, the downward surprise, if you want, is much more related to this, unbalanced recovery of investment, taking into account sectors that rely more on banking financing vis-a-vis the capital market.
Okay. And let me just finish, because we're running out of time too, with one question coming from the audience. It's a little bit of a combination of a structural question and something that we're seeing today. So this person is telling me, so the real neutral interest rate in the US seems to be around 1% or slightly below 1%. So how should we think about Chile's estimation that the real neutral rate there is 1% as well, the midpoint?
Mm-hmm.
And the second part of the question is something more related to the current situation. What is your perception or your reading of the fact that swap markets today are expecting a terminal rate in Chile close to 4.5%, which would be at the top of the range of the neutral rate, in a context where markets already started to price around 135 basis points of cuts in the US, when in your last EPOM you had only 50. What's your reaction to that?
Yeah. So in terms of the neutral rate, we have a range of estimations, some of them based on growth, local growth, trend growth. So we link the neutral rate to trend growth. And there are some other models that link the neutral rate, our neutral rate, to global neutral rates, to put it in a way. So more related to external factor, the UIP, non-arbitrage condition. So there are different models, and those different models give you some different readings of the neutral rate. So if you want models that give more weight to local factors, tend to have a lower neutral rate. Models that put more weight on external factor tend to give you a higher neutral rate. We have a range because we think both considerations are valid, and that's why we have this range. It is true that the upper bound of the neutral rate, the real part is 1.5, so a bit above what could be the neutral rate in the US. And probably that model is much more based on the UAP condition rather than growth. And when you have, a downward revision of trend growth, as we have done in the previous years, the natural outcome is to have a downward revision of the neutral rate. That's why we have also a range that includes lower neutral rate. So that is what I can tell you, and we will assess on a regular basis whether we give more weight to one or the other. Usually we calibrate our models with the median of our estimations for the bunch of models that we have. But then in our monetary policy assessment, we can, each of us, each of the board members can assess differently what it's more relevant for our economy. Now, in terms of the cuts, yeah, I think it's too early to call. We have seen a lot of movement in the swap rates. A couple of weeks ago, the terminal rate, the market was pricing a terminal rate at 5%. Now it's down to 4.50, probably reflecting the global movement we've seen up to now. Again, we have to wait until the dust is settled before having a more robust assessment of what is going on.
Okay. Claudio, thank you very much. It's 11 a.m. in Chile, 11 a.m. in New York, so sharp in time. Thank you very much again for accepting this invitation. I hope it was useful for the people who connected. And good luck with this uncertainty that we're facing right now. Yeah. And hopefully we'll talk to you soon.
Okay.
Thanks again.
Thank you.
Okay. Take care. Bye-bye.